Jeremy Serio here from CRA Invested. So welcome to Module 3. Module 3 is the other half of defining your target. This is the financial target module. Now Module 2, what we just talked about, was focusing on developing your strategy and your why. We looked at what motivates you to invest in commercial real estate. We also talked about some of the qualifiers that will push you forward in your why, and then defining your target, whether it's a geography, industry, asset type, or a problem. And you're going to find that any one of these or a combination of these can formulate a sound targeting strategy for moving yourself into a specific framework for finding the deals that you're looking to invest in. The other part of this is this Module 3 piece, which is looking at the financial target. If you don't know what you're looking to buy and why, you won't really recognize it when you see it. And if you don't have a financial parameter of what that deal needs to do for you, then you don't really know if it's something that's going to fly or not. But before we jump into breaking into these individual measures, I'm just going to take a moment and refer to a quote from Ben Graham. Ben Graham was Warren Buffett's professor at Columbia University, and he's written a lot of books on value investing. And what he says is the individual investor, which is you, should act consistently as an investor and not as a speculator. So you don't want to go out and really make gut calls on deals. You want to have a target or a framework that gives you a picture of what you're looking for, so that when you do see opportunities or deals, and you will, that fit in that framework, you're going to know very quickly whether you should pull the trigger on it or not. So Module 3 agenda, here's what we're going to talk about. We're going to talk about your financial target. We're also going to look at some income and expense accounting. We're going to talk about the gross rent multiplier, cap rate, cash on cash and target cap rate, as well as annualized return, and ultimately the internal rate of return. When you're picking your measure, you're probably going to find that you're comfortable with one or two of these. It's very important to lock on to one or two, because when you do, you're actually going to be comfortable with it. By the end of this module, you're going to understand the pros to using the measure that you like and the cons as well. And when you understand the cons, you can understand the risks, the downsides, and the portion of the story that measure is not telling you about the deal you're evaluating. So breaking these up, what you're going to find is that investors use different types. So you're going to find people talking in terms of cap rates, cash on cash returns, all kinds of different measures all over the market in all different parts of the country, and it's going to vary. Everyone's got a little different way of looking at things. But in what you'll find, though, is that private investors are really going to focus on three primary measures. They're going to look at gross rent multiplier, cap rate, and cash on cash. As you go into the industrial space, what you'll find is that in the private investor space, the gross rent multiplier, cap rate, and cash on cash are the most popular measures. The institutional world likes to use internal rate of return, and they use equity multiples. So when you're really deciding on what target you're going to use, it's really up to what you're most comfortable with. But you'll find that one or two of these really will fit. So before we do that, we need to understand what powers the measure. And what powers the measure is a breakdown of the income and expense accounting. You have your total rental income. That's the amount of revenue that a property is currently producing or is producing at its maximally leased moment. That means it's 100% occupied at market rent. Below that number is your vacancy or credit loss. Now, when you're looking at property, a lot of owners are going to try to sell you a deal that's 100% occupied with no vacancy or credit loss factor. But you know better. You know that the market doesn't work that efficiently. You're going to have tenants that aren't going to pay rent. They're going to be late. You're also going to carry empty space. In fact, there has to be empty space in order for the market to work properly. So you got to price that into your deal and make sure you're accounting for it. One of the best things to do is to look at market guides and reports, and you can get an idea of what the market vacancy rate is in your area. And once you've done that, you can start to see whether the property that you're looking at is over, at, or underperforming on vacancy factor. So you got to subtract out that vacant space. It's not producing revenue for you. Once you subtract that out, you now add in other income. If you're fortunate enough to have a cell tower, billboard, maybe some land you lease out, or it could be a laundry facility in the property, that's added back in as additional rent. Once you do that math, you come to your gross operating income line. Your gross operating income line gives you the amount of money that you have to operate the property. And below that line, you have all those operating expenses. You're going to have real estate taxes, common area maintenance, insurance, accounting, legal. You might even have a reserve line in there. A lot of banks like to build that in. It's not an expense, but you should probably build a reserve in. You'll have repairs, maintenance, marketing, advertising, that type of thing. After you've deducted all those expenses, you come down to a net number, and that net number is your net operating income. That net operating income number is the number that you're going to use to capitalize the property. It's also the money that you have remaining in your checking account to pay the bank if you've borrowed and taken a mortgage out to actually own and operate the property. Now, moving into the first measure, gross rent multiplier. What is this thing? Well, the gross rent multiplier is a very fast way to measure opportunities. And what this number does is it takes that total market rent, or that total rent being produced by a property, and it comes up with a multiple on that rent to the value. So it's a relationship between the rent and the value. Here's the formula. What you do is you take the value of the property and you divide it by that total rental income. When you divide that number by total rental income, you get your gross rent multiplier. So in this example, you see we have $1 million divided by $100,000, and that equals a 10 multiple. Another way to calculate this is to take your potential rental income, multiply it by your multiplier, and you get your value. So that could be $100,000 times 10, gives you a $1 million value. Another way, for your value divided by your multiplier to come up with that total rental income, that's your $1 million value divided by 10, and that gives you $100,000. So what are the pros and cons on the multiplier? Well, pros are that it's fast, it's simple, it accounts for gross rent and value. The cons are that it assumes 100% occupancy. It does not factor vacancy into this scenario. It does not include expenses. It does not include debt service, and it gives you a one-year picture. So there are some downsides, and as long as you understand what those are when you are in fact running a gross rent multiplier, you can understand that you are taking some risks on not factoring in key pieces of information into your analysis. So moving into the cap rate. What is this cap rate thing really? Well, the cap rate is one of the most popular used measures in commercial real estate investing. I also find that it's one of the most commonly misused measures. So let's start with defining what the cap rate really is. The cap rate is an investment measure. It's defined as the ratio relationship, that means it's a percentage, between the first year's net operating income and the purchase price of your investment property. So in English, here's another way to think about it. It's the percentage of the purchase price that you're getting back in the first 12 months in net operating income. So if you pay $1 million and you receive $100,000 in net operating income back over the next 12 months, you're essentially getting 10% of your money back. That's your cap rate. Now the cap rate can be very useful in terms of coming up with the value, because it does tell you what the velocity of that NOI is in relationship to the value that you're paying for the property. It's reflected in a formula like this. Take the net operating income, divide it by the cap rate, and you come up with your value. So if I have a $100,000 property, and it's priced at a 10 cap, then I know the owner wants $1 million for it. If I have a $1 million property and I know it's priced at a 10 cap, I have an idea what the net operating income is. It's $100,000. This is actually a great tool to use if you're a retail investor and you're looking at, say, Starbucks, and you're trying to figure out how much rent they actually pay. Well, what you can do is go online, go to LoopNet, look up Starbucks properties in a given market, and you'll see ones that are for sale at a specific cap rate. You can use this formula right here to solve for the NOI. So you actually know the price per square foot that Starbucks is in fact paying for the space they occupy. Another formula with cap rate, we just move some things around. We have our NOI divided by our value. That we can use to solve for the cap rate. So $100,000 NOI divided by $1 million equals a 10% cap rate. Now, common question you might be asking yourself, and a lot of people do ask themselves this question, is how do I know what a good cap rate is? Well, it's a great question. Unfortunately, there's no black and white answer to that. I can't sit here and tell you the right cap rate that you should use to invest in any property. But what I can do is point you to a guide that provides you with a benchmarking of what other investors are paying for different asset types in the U.S. based on a cap rate approach. That guide is located at IRR.com. That's www.irr.com. IRR is Integra Realty Resources. On the front page of their website, they have a link that you can go to and fill out for their 2012, 2011, 2013 viewpoint guide. They produce these annually. These guides will give you a benchmark of what people are actually doing in the marketplace. So as you go in there, you'll see tables, and one of the tables would look like this. It would have property type, urban multifamily, suburban multifamily, regional malls, CBD office, suburban office. It'll give you the lows, the highs, and the averages based on cap rate of what people are actually paying for these properties. So that's a good tool to benchmark. But again, the right cap rate for you is going to be specific to what your strategy is and your why and what you're trying to accomplish financially. And we're actually going to talk about that in a minute. But before we do that, let's talk about the pros and cons really quickly of the cap rate. So to wrap up cap rates, the pros are it's pretty fast, it's pretty easy to use, and it accounts for gross rent, vacancy, and operating expenses. So you get a pretty good picture on what the cap rate tells you. Downsides on cap rate. It's a one-year picture. Now, if you're like most people, you're not going to just buy a property for a year and then be done with it. You're probably going to end up owning it for several years. Cap rate's not telling you what's going on in the subsequent years with the property after you bought it. It's easy to misuse. You're going to find that a lot of people make mistakes in that income and expense accounting to get to the NOI to calculate the cap rate. You'll also find that they might actually think a cap rate is a gross rent multiplier and multiply the total rent by that multiple to come up with a value, and they'll call it a cap rate. That'll happen. It doesn't account for debt service, so cap rate isn't telling you how much of a loan you can get or what you're actually paying for your loan. It doesn't include taxes either, that after-tax picture. So now that you understand some of the downsides of cap rate, let's go ahead and practice a couple of these. So what I'd like you to do is go in to exercise 3.1 and calculate the gross rent multiplier and cap rate in your book there, in the manual. Now, you do have a calculator you can use. It's that financial targeting tool calculator. Open that, and when you do, make sure you enable the macros. When you enable those macros, that'll allow all the formulas in that spreadsheet to work. So now that you've actually practiced the multiplier and the cap rate formulas, let's talk about a little piece of cap rate here that you got to plan for. Now you remember, cap rate was a one-year picture. If you're planning on holding a property for multiple years, you are going to have to put a valuation on it at the end of your holding period. The most common approach to doing this is to come up with an exit cap rate. Now, the exit cap rate is also known as a terminal cap rate. This places a value on your investment at the end of the holding period. It's a way for you to calculate your potential profit. But one thing I would recommend is you want to be conservative in how you do that. You don't necessarily want to go in and say, hey, I'm going to buy it at 10 and I'm going to sell it at 7 because I think somebody 5 years from now will pay a 7 cap for this property. You want to be careful. What I would recommend you do is if you have a stabilized property with a stabilized cap rate, that means that the property is producing a positive cash flow, you understand what the expenses are, there's a market vacancy or you're doing a little better than market on your vacancy rate. You've got those numbers kind of dialed in. Give yourself a range. You might want to put an exit cap rate, put maybe 3 exit cap rates that are 0.5 point, equal to or half a point higher than the cap rate that you're using today. That will give you a best, most likely, and worst case scenario on your valuation 5 years out from now, and it will allow you to start to get an idea of what your actual sale price at the end of the 5-year hold or 10-year or however long you plan on holding the property might be. And the other thing to remember is the next guy who's buying your property is going to be looking at it the same way you are. They're going to put a cap rate on it. So you don't want to be too unrealistic because you may end up paying the price for that. Here's how you calculate it. For the exit cap rate, you take your end of period net operating income divided by the value to come up with the cap rate. Now that end of period NOI, there's a little trick here that I want to make sure you're aware of. When you're calculating your future cash flows, those future NOIs, you want to make sure that when you're selling and you're projecting that sale value, that you're using the forward 12 months of NOI to do that. So an example of this would be if you sell at the end of 7 years, you want to use the year 8 NOI to come up with your year 7 value. And the reason for that is that, remember, someone's going to pay you, say, $1 million in order to get $100,000 back a year. Well, if you think you're going to have $100,000 coming back in year 8, they'll give you $1 million in year 7 to get that $100,000 in year 8. So that's why you're going to use that forward 12 months of net operating income in order to solve that problem. So let's go ahead and go into exercise 3.2. And what I'd like you to do is complete this exercise. This is another cap rate exercise that's going to factor in some of those exit assumptions. So now that you've completed exercise 3.2 and you've seen how that cap rate works, let's move into cash on cash. This is another one of those really popular measures that you might actually like to use, and I actually like it because it gives you an idea of the velocity of your money and how fast it's coming back to you. So what cash on cash measures is the percentage of your down payment that your investment pays to you in the first 12 months. So in a formula form, what this looks like is you take your year 1 cash flow, divide that by your initial investment, and that equals your cash on cash return. So in hard numbers, you may get $10,000 back, and you put $100,000 down to get that money. You're getting essentially 10% of your money back. Now, caveat that I'd like to point out to you is this. With your cash flow is equal to your net operating income if you own all cash and you have no debt. There's no mortgage. However, if you have a mortgage, your cash flow is equal to the NOI minus your annual debt service or the sum payments of all those mortgages you're going to make over the next 12 months. That is your cash flow. So in this example, if you had maybe $100,000 mortgage, or let's say it's $100,000 NOI less a $90,000 mortgage, that's going to give you a $10,000 a year cash flow. So again, you'd invest $100,000, you get $10,000 back. That's a 10% cash on cash return. The importance there is that debt service does factor into this, and what debt service does is it separates your NOI from your cash flow. And as I said, if you have no debt service, then your NOI and your cash flow are the same thing. So for some of the pros and cons on cash return, pros are it's fast, it's easy to use, it accounts for gross rent, vacancy, operating expenses, and debt service. It also accounts for after-tax cash flows if you're in fact applying a tax rate to those cash flows that you're taking in. The downsides on cash are, again, it gives you a 1-year snapshot. So just like the gross rent multiplier and the cap rate, you're getting a 1-year picture. The only way that you can get a multi-year picture is to do an annual calculation. That's to go out into future years with assumptions on what your income and expenses and your debt service look like, and solving each year for that cash on cash return. What you're likely to see is that cash on cash return will fluctuate and change over time. Cash on cash also doesn't tell you any appreciation that you're creating in the property, and it doesn't account for amortization either. Amortization being that principal reduction on the loan that you took out to buy the property or to own it. Now here's a really cool tool that I like. This is the target cap rate tool. The target cap rate measure combines the cash on cash and the cap rate as well as your debt service to give you a target number that you should be using as your cap rate. This is a very cool process, and what it is it's built on what's called the band of investment theory. What this allows you to do is to build up to a cap rate that includes your debt assumptions. So that's how much I'm paying a lender to borrow money, as well as the cash on cash that I want to get on my initial investment, my down payment. It takes those two pieces of information and adds them together to come up with a cap rate that fits your measure, your target. It locks you into what you're looking for. So in order to solve for this, what you do is you take your financing component, that's the debt service, you're adding your equity component, which is really your cash on cash return, and you're building it up to a cap rate. So here's an example of what a cap rate problem would be solving for this using this information. So you're looking at $1 million property, except now you're going to borrow $800,000 at 5.5% interest over 25 years. You'd like to earn a 13.23% cash on cash return on your $200,000 investment. What is your target cap rate? What cap rate should you be using in order to pay that debt and get your cash flow? Well, that's an interesting question. I think this is really a question that you've asked yourself, and it's a very important piece to look at. So what you'll do is you'll use the target cap rate tool to solve that problem. And in the calculator, open up that financial targeting tool and go to exercise 3.3. And what I want you to do is take the information in those problems, plug it into the calculator, and solve. And what you're going to see is you're going to get a target cap rate. After you've completed that exercise, I'd like you to go ahead and move on to 3.4 and 3.5. And what you'll be doing there is you'll be solving for your target NOI. So you're actually, after you have that target cap rate, you'll know the NOI you need to accomplish in order to get to those cash on cash returns you need and the mortgage information that you need to cover. And then I'd like you to do exercise 3.5, creating your target cap rate. So now that you've gone through the exercises and you've actually solved some of these problems, you're starting to see that you can use this tool to build your multiplier, your cap rate, your cash on cash return, and your target cap rate. And you're probably starting to gain some familiarity and comfort with how those work. I'm going to give you another measure that you can use to set this target, and this is called annualized return. What your annualized return does is it takes the sum of your annual cash on cash returns. So you're familiar with cash on cash. You've worked through that. You understand what's going on there. But now you have a debt picture factored in. And the debt picture, as you know, unless you're paying an interest-only loan, you're paying down the debt. And that percent of principal reduction, it's kind of like a forced savings account with the property. And what you might want to know is, what is my annual return on my money if I have a cash on cash coming in and I'm putting money into that loan pay down, that savings account, that forced savings account? What's my annualized return there? So I'm giving you this formula. Here's how it works. You take your year one cash on cash, add your percent loan reduction, and you come up with your annualized return. Now what that does, that percent loan reduction, is it actually takes into consideration the amount of the loan you've paid down against your down payment. So you're coming up with this total picture annually of how much money is coming back to you over the year that you're looking at. So pros and cons on this. Pros are that this is a cash on cash based analysis. So if you like that metric of finding out how fast your money is coming back to you, the annualized return can help you do that. It also accounts for principal reduction. So when you have a loan and you're paying it down, well, you're building equity. And that building equity is a return of part of your down payment. It also accounts for gross rent, vacancy, operating expenses, and debt service, and it accounts for after-tax picture as well. The cons the cons here, that you get a one-year snapshot. It can change annually, it doesn't tell you appreciation, and it doesn't account for what you actually sell the property for and you pay to sell it for. The annual change on it will depend on how fast the loan's being paid down, as well as how much cash on cash you're getting. So what you'll find is that each year, that annualized return can and probably will change for you. How about IRR? What does this internal rate of return thing do? Well, internal rate of return is the return on and of your down payment during the investment holding period. It tells you what your profit is. So what I love about this is that it gives you a total picture, for the most part, of what's happening over a multi-year holding period with your investment. And this is a favorite among institutional investors. Now, remember in cap rate, we went out and we looked at the IRR.com viewpoint guide? Well, in that guide is a section that actually tells you the prevailing discount rates or internal rates of return that investors are looking for in the commercial real estate market. You can go in there and, again, by asset type, see the highs, the lows, and the averages for what the expected returns are. And those expected returns are based on how much money someone's putting into the deal, the cash flows that are coming back out of the deal, the amount of loan reduction that's occurring, and then how much they're selling the property for and what their net proceeds are after they've paid to sell it. So it gives you a multi-pronged picture of how the investment is performing over a period of time. That's a great tool to use, and it might be one you want to consider looking at if you're not already using it. The pros on IRR is that it does include cash on cash, it accounts for principal reduction, it does account for gross rent, vacancy, operating expenses, and debt service. It also tells you about appreciation. And remember, your appreciation is going to be tied largely to what someone's willing to pay at the end of the holding period, but it's also going to be tied to the cap rate that you're using to calculate that exit. It tells you about your sale proceeds as well. So the sale proceeds are that total sale price less what you had to pay to sell the property, like broker's fees, legal fees, mortgage payoffs, that type of thing. The downsides on IRR is that it doesn't account for negative cash flows. It also assumes that all the cash flows remain invested in the investment at the internal rate of return. Now that's a problem if you're planning on taking the cash flows out and, say, going to buy a boat. It doesn't tell you what happens to that money once it leaves the investment. It also has a few shortcomings when you're comparing different investments. If you're looking at one investment over a 3-year period and you're looking at another over a 5-year period, you might be putting a different amount of money down on one than you are the other, which is really how the world works. You're going to find that your IRRs aren't necessarily telling you the right story about what's going on in those two investments. So it's not a perfect tool. And you're also susceptible with IRR to having exit assumptions that are flawed. If you remember how I talked about not taking that 10 cap and then assuming you'll sell at a 7 automatically because of course someone would pay you more money at the end of your holding period for the property, you want to be careful and not rely on flawed exit assumptions when you're calculating your IRR because it can really skew your numbers. So now that you've seen IRR and sort of conceptually how it works, go in and do exercise 3.6. You're going to use that financial targeting tool again, and you're going to plug the numbers in and solve the problems. So now that you've finished 3.6, let's talk about what the next section has in store for us. What we're going to talk about in Module 4 is debt. Commercial real estate investors are very accustomed to using it. And what we're going to do is focus on leveraging debt, talk about mortgages. We're going to look at owner financing. We're going to discuss loan assumptions and what they really mean, what non-recourse and recourse financing looks like, as well as talking about raising equity. That's Module 4. That's our next session. This is the end of Module 3. Thanks for being here with me. Hopefully now you're starting to see that you've got your Module 2 strategy and why worked out. You know what your target looks like. You know where you're going. You know what you're looking for and why. And now after completing Module 3, you understand what needs to happen inside that target financially in order for those investments to pay off for you. So once you have those two pictures interlinked and married, now we're going to go into Module 4 and talk about leveraging debt and seeing what we can do there to really maximize the return on your investment.